Bollinger Bands are one of the most useful indicators you can use in your trading. In this video, we will talk about what Bollinger Bands are, how they work, and how they can be useful in your trading. Before we go in depth with the indicator itself, we need to understand a key basic statistical concept, standard deviation. Trading without understanding standard deviation is like driving blind. It is hugely important to understand how prices move. Standard deviation is a measure of the variation or spread of a set of values. A low standard deviation indicates that the values tend to be close to the mean or average, while high standard deviation indicates that the values are distributed over a broader data range, meaning that there is more variation. Standard deviation tells us how much the values deviate from a data mean. In trading, standard deviation shows how much prices have deviated from the average price. Bollinger Bands use standard deviation, and this allows us to identify the volatility of a certain financial instrument and also when the current price has deviated too much from the average prices for that asset. When we see that the Bollinger Bands are quite high, it means that there is low volatility. On the other hand, if the bands are quite wide and distant from the average price, we can deduce that the volatility is quite high in that asset, and knowing the volatility of an instrument is extremely important to work out how much risk to take on. Traders tend to use Bollinger Bands as possible support levels when the trade has drifted substantially lower and touched the lower band, whereas conversely, if the market has drifted wide to the upside and reaches the upper Bollinger Band, traders will use that reference as a potential resistance point. If you want to learn more about support and resistance, check out this video linked in the description. That is why traders use Bollinger Bands to initiate buy orders when a price reaches the lower band, or conversely, sell orders when price interacts with the upper band. Traders use the average price level as the exit target in a position or the opposite band from which the market operation began. This will depend on each trader and the strategy they decide to use. Bollinger Bands work best when there is no strong trend in the market and prices tend to go back to their average price level. This is what is commonly called as a mean reversion strategy, meaning that we expect prices to go back to the mean. This is the case since when the financial instrument is in the process of searching for a new equilibrium price and it is operating a trend or showing a strong directional price action, the price can be located continuously above or below the Bollinger Bands and therefore provide multiple false mean reversion signals. The ADX can be a very useful indicator in conjunction with Bollinger Bands to determine when it can be used as a mean reversion indicator. We'll make another video on that if you are interested. Let us know in the comments. Bollinger Bands can also be used in trading markets, although the suggestion here is not to use them as a mean reversion indicator and look for trades only in line with the trend, where if the trend is positive, look to start long trades when the upper band is pierced or when support is found in the lower band. In a downtrend, opportunities will be sought on the downside with sell orders. When it comes to setting up the Bollinger Bands, some of the most commonly configurations or used values by traders are setting the bands to 20 periods and 2 standard deviation. This, in theory, tells us that taking the last 20 periods as a reference, 90% of future prices should remain within the Bollinger Bands. However, if new information enters the market and the market is in the process of seeking a new equilibrium price action may exceed and remain above or below the limits of the bands. Traders, I hope this information has been of benefit to you, and we at Pepperstone wish you the best of luck in your trading.